Yes, welcome to DC Economics. Today I'm going to take you through introductory part about corporate finance. Corporate finance refers to the activities and transactions related to raising capital to create, develop, and acquire business. So it is directly related to company decisions that have financial or monetary impacts. Example of corporate finance is like you take a loan from a bank to meet a business needs associated due to diligence to analyze the cost of loan repayments capacities. There are some essential elements in corporate finance that include operating flows, invested capital, cost of capital as well. So operating flows indicates whether a company can generate sufficient positive cash flow to maintain a growth in its operations. So it reflects the actual flows experienced by a company as a result of its operations. So in one way or another, the cost of capital actual tend to represent the minimum return required by the two major sources of capital, debts and equity. So it tends to address on an issue of a minimum return required by the two major sources of capital and equity as well. So the issue of invested capital, total assets constitutes invested capital, whereby the total amount of money raised by a company by issuing securities to equity shareholders and debt bondholders and etc. So corporate finance has got some principles. The first principle is investment principle, finance principle, and dividend principle. So investment principle focuses on the significance of investing in the suitable option by assessing the risk and returns. So the evaluation of investment proposal should be based on the predetermined hurdle rate that saves the return analysis or benchmark. So actually, in investment principle, we should analyze if the cost of acquired capital is greater than expected return. So we expect that the expected returns to be greater than what is known as the capital that is offsetting. So another principle is financial principle. So they influence the selection of financing method to ensure that the extraction of maximum value from the investment. So under financial principles, many factors affect the capital structure, such as business structure and goods, and some costs of the financing interest rates affect the equity market. So under divergent principle, the divergent principles of an entity explains whether to stimulate surplus towards the business growth or shareholders in the form of dividends. So the company try to examine if it would be possible to give a dividend to shareholders or to still invest into the company to increase surplus. So there are some central elements in corporate finance. So corporate finance major focus areas include capital budgeting, working capital, together with dividend decisions. So under capital budgeting process, here the discloses the availability of investment proposals and it helps in invest in profitable projects. So they go under capital budget processing is to maximize the growth and profitability of the business. As a part of capital budgeting, financial analytics go over various investment alternatives. So they conduct a comparative analysis of investment, present and future value to interpret their risk, returns, aspects concerning organization goals. Only the most suitable projects are given by the chance. So under capital structure, it tells us the method of financing used by the entity. So the capital structure might include equity, retained earning, debts, and so forth. Third one is a working capital. Working capital refers to the capital for day-to-day business operations. So efficient financial management can ensure that an adequate cash flow is in line with business policies. So in this way, maintaining the liquidity of the organization can save from going bankrupt under working capital. So working capital, they refer to the capital for day-to-day business operations. So efficient financial management can ensure that there is no bankrupt of the company. So it can ensure the adequate cash flows lines with business policies. Let's talk about corporate finance, types of corporate finance. So we have the two types of corporate finance include equity financing and debt financing. So equity financing involves a company sells shares to investors. So the company can raise financing through equity issuance or obtain from the retained earnings. So equity comes in the form of common stock and preference stock. Common stock is a class of stock that represent ownership in a corporation, whereby preference stock, these are the shares of a company stock with dividends that are paid out to shareholders before the common stock dividends are issued. Under what is known as equity financing, a company can sell shares by getting itself unlisted on a stock exchange or through what is known as over-counter, OTC. So a company can sell shares by getting itself on the listed on a stock exchange or the over-counter OTC. Concerning about debt financing, under debt financing, a company can raise money by selling debt instruments to investors. So actual debt financing is sometimes referred to as the opposite of what is known as equity financing. Under debt financing, this refers to the obtaining the finance required through the loans usual from the financial institutions or through the bond issuance and etc. So debt financing attracts the cost of regular interest payments and the repayment of the principal at the end of the loan tenure. At the end of the loan tenure. So the too much of the debt induces the risk of default or going bankrupt. So in case of non-requirements of the debt. So we look on how the bank or institutions obtain financing and how they utilize those financing and how they make regular payments and regular interest payments on such kind of loans. Also, they work to make sure that they organize to not enter into a bankrupt or failure for all loans defaults in one way or another. Thank you for watching. Welcome to BC Economics. Don't forget to subscribe and watch on other videos. Bye bye.